Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500. Don't forget to like this video and subscribe for more great investing videos. Today we are discussing Abbvie Inc., ticker ABBV, and we're going to go over the business analysis, fundamental analysis, and give you a valuation, all in this 5-minute video. So today, let's begin up here at the market cap. This company is $196 billion market cap. It's very large. So what is the business? It discovers, develops, manufactures, and sells pharmaceuticals in the United States. Pharmaceuticals means drugs. Basically, they offer Humira, which is Humira, Rinvoq, JAK inhibitor. Here is for various diseases. So quickly we can see they're listing all the different diseases and drugs that they are known for. So drug manufacturing company. Generally, these companies are quite volatile over time. They'll have very succinct parts, 5-10 year periods where they make a lot of money off a drug. And then when the drug goes off patent, then their prices drop and then they start losing money and they're not as effective in there. So it's kind of hard to predict long-term returns. In general, they've made a lot of money, but I don't generally like these businesses. So let's dive in next to beta. Beta is less than 1. That's always a good sign. It's at 0.80, not as low as I'd like. I'd like it closer to 0.5 or 0.7. And the share turnover is right near 100%. So it's going to trade very similarly to most S&P 500 stocks. Return on invested capital is where I want to go next. So we can see it's pretty heavily above 10 to 15% all the time. So it's quite volatile, 53%, 24%, 42%, 19%, but it's always above 10 to 15% besides this last year. That's a pretty good sign. I like it to be in that 10 to 20% range solidly, and it meets that quite well. So now our CAGRs. So revenue has grown at a solid 11% per year over time. That's very good, very positive. We want to see this 10 to 15% revenue growth is what we want to see. And we're seeing free cash flow growth in that range as well. That's a good sign. Not as good that assets are growing faster than revenue. That suggests that they're kind of funding it with debt perhaps. And you can see that same suggestion because return on assets is 10%, but return on equity is 87%. So there's probably some leverage. And I think that's what we see with the capital structure here. It's probably a pretty levered company. But in general, going from 17 billion in revenue to 45 billion in revenue, you're going to see a lot of success if you can do that. I'm not sure why it shows EPS is flat. It says $2.17 here and $2.72 there. So something's going on here, but it did peak at around $5, which would have been a good ending point if that's what it would actually be. So on valuation, we quickly see it's heavily overvalued. Anything in the 42 range, that's very expensive. You need a very high growth rate to justify that. That's an earnings yield of 2.5%. You need to grow at these types of rates for multiple decades in order to justify that. And that's going to be really hard to do because it looks like their growth is probably unsustainable with this asset growth exceeding the revenue growth. But let's look at the balance sheet to get another look. So here in the balance sheet, I'm really concerned about debt. So let's see what the debt looks like. So to begin, back in 2010, 2011, they had no debt. And then they've grown from 2012 with $14 billion all the way up to $77 billion in debt. Their debt's gone up 5x in the last 8-10 years. That is significant. That's hugely significant. That's been a major driver of their business because, okay, so their debt's increased 5x, but how much has their income gone up? So here we go. EPS so we got 3.4 billion in income up to 5 billion in income, generously 5 billion. So they've gone up an extra $1 billion in income, but they've increased the balance sheet by $77 billion in debt. That's insane. Their debt is, oh my goodness. So their income, net income here is $5 billion. But let's be generous and say operating profit, okay? We'll go operating profit, give them a little bit more benefit of the doubt because their interest is causing that to get wiped out a bit. So their operating profit's grown from $4 billion to $12.5 billion, $13 billion. But they're $13 billion compared to the long-term debt of $77 billion. You still have 5 times your total operating profit in long-term debt. This is a very leveraged business. I'd be quite concerned about the debt load in this company. It means that their growth rates are unsustainable. And it also means that this company is extremely overvalued. They cannot sustain a revenue growth rate of 11% going forward if it's driven by asset growth that exceeds it. So this was the sign that got me concerned. The PE ratio is completely out of whack with what their ratio is. You're not giving any benefit of the doubt for the fact that you have all your leverage already built into it. No interest at all in this company. I would stay away myself. So that's ABBV. Please stick around, like this video if you want more investing content, and don't forget to subscribe to the channel.